4:25, about 40 minutes before the markets close West Coast time. This is your midweek update coming at you a little before midweek. It's the best opportunity, and I am compelled, based on what I'm seeing in the markets, to send out a message to you anyway right here. So I'm not going to spend really any time on the Middle East crisis in this presentation, other than initially the markets responded, aggressively to the upside last night when the president announced the ceasefire. There was no ceasefire initially. There seemed to be no let up in the attacks in both directions. The president got very strong in his language on his social media platform post. And since then, from what I gather, there has been a ceasefire. So the markets seem to be loving that today. Most averages are up over 1% as I speak. I think the NASDAQ is, up 1 2/3%. Foreign markets are up a bunch. Our emerging markets, one of our ETFs is up 2.25%. The other one is up 1.6%. Our exposure to Mexico is up over 2%. South Africa is up over 2%, and so forth. So our tilt to non-US, which I've talked about a lot, Europe's up 1 3/4%. That's helping. Gold is taking a pretty good hit today, and we'll talk about that here in a moment. What's not working, consumer staples stocks, which aren't small for us, are flat, down 0.01%. Our ag commodity exposure is down about 0.5%. Palladium is down about 1%. Silver is down 1.3%. Gold has come back a little bit from where it was earlier. It was down over 2%. Now it's down 1 3/4%, and gold miners are down 2.3%. So keep in mind, silver and gold have been phenomenal, or very important for us to own so far this year. But as I've been showing you in the charts, the technicals for gold short term to me have looked very bearish, and I'll update you on that right now here in a second. So we shall see, how far this goes in the Middle East. The market's responding so wonderfully to it. Makes sense, meaning wonderfully to a ceasefire. Would be very problematic if Iran chose the Strait of Hormuz as a way to retaliate by closing up what amounts to 20+% of global shipments of oil. That would be just incredibly damaging, I think, to them from a number of fronts, of course, economically, but the retaliation would be huge and so on. So anyway, there's so much in the press. You don't need me to probably update you on that other than market's reaction to it. What I did want to touch base on today is the Fed and the president's very aggressive call for them to get very aggressive in lowering interest rates. First of all, the Fed is supposed to stay neutral or stay out of the political process and independent, I should say, of the administration. History suggests that's not always the case, and we can debate whether that's been the case in modern history as well. But what I wanted to touch base on again is I refreshed the chart that I shared with you a week or two ago. The president, again, is calling for two to three interest rate point cuts, so 200 to 300 basis points, like right now, in rate cuts. He's railing against the Fed. The European Central Bank has been cutting rates, England and other places as well. Well, we're in a very different situation than they are. None of those countries stimulated remotely like the U.S. did, and inflation isn't as prevalent in many of those places, and their economies are weaker than the U.S.'s economy right now. And what I wanted to touch base on would be the danger if the timing is wrong, because it seems to be that, and this is consensus thinking among most people, and it seems to be the president's thinking as well, that if the Fed were to cut interest rates, the cost of borrowing, and that's what he's really focusing on right now for the U.S. government, would be cut by like $800 billion. And indeed, that's possible, but typically the Fed follows the bond market, follows interest rates when it comes to government securities, market-based interest rates. It doesn't really dictate them. Some would argue with me on that, but this has been my 40-year observation of watching markets. And just the absolute perfect example is last year. Last September, the Fed cut interest rates twice in one meeting. So one cut is 25 basis points or 1/4%. They dropped 50 basis points in September. And I know I showed you this already, but I think it's worth bringing up again. Then in October, they cut a 1/4 point. Then in December, they cut a 1/4 point. So on the top panel, what you are seeing is the 2-year, 7-year, and 10-year Treasury debt yields, the cost of debt to the Treasury. Now, so this tracks the price of existing bonds, which affects the ultimate yield for anybody wanting to buy an existing bond, but this is also going to be reflective of the auction interest rates as well. So here the Fed cut interest rates, essentially 4 interest rate cuts over 3 meetings, and the borrowing to the government not only did not go down and save a bunch of money, it made it significantly more expensive for new debt. You can see that the 7-year, the purple line, went from 3.5% all the way up to 4.7% at the peak. The 10-year, which, dictates where mortgage rates are largely, 3.6% to 4.8%. And even the 2-year went from 3.5% to, say, 4.4% at the peak. Now, they've come down off of that a bit, but they're still elevated from these levels. And mortgage rates, for your American home buyer, went from 6.58% all the way up to 7.41%. So unequivocally, no. If the timing is wrong, if the economy is still in decent shape, and Powell was falling all over himself to tell Congress that the economy is still in great shape. That's not our view, to be honest with you. But if indeed he's right, and the economy does not warrant a cut in the Fed funds rate, if it's viewed as stimulative, interest rates will go in the other direction. If it's viewed as necessary because the economy is rolling over, then interest rates, will have already begun to roll over. And they have to some degree. Again, I'm showing you the peaks right here. In fact, let me just bring that forward to current for you. So if we bring it up to today, the 24th of June, you'll see what I mean. So they have come off the boil for sure. So we're now, we've gone from 4.7 on the 7-year down to 4.0, 4 point even. We've gone from 4.8 on the 10-year to 4.2, and we've gone from 4.3 on the 2-year to 3.8. Now the 2-year is considered a reflection of where the Fed funds rate may be going. So that it is suggesting that, maybe rate cuts would be coming in the not too distant future. Now, what Powell said is that if inflation does continue to abate, continue to calm down, then they will be cutting rates later in the year. The futures market is discounting high odds of 2 cuts between now and the end of the year taking place in September and December. I actually think that makes a lot of sense to me based on our current observation of where the economy is heading. Consumer confidence, for example, came in today disappointingly. However, inflation expectations are way elevated still. And make no mistake, folks, we really haven't seen the impact of tariffs rolling through all the price action. In the business surveys, it does look like there's lots of price increases as a result of tariff action. Now, oil coming back down will offset that certainly in the way they measure inflation and so on. So we shall see, but stagflation is kind of on the menu right here when you look at a somewhat weakening economy and perhaps higher stubborn inflation. So if the Fed times it right and it's later in the year, rates will already be lower. The bond market will be telling them to do that. So anyway, I just want to kind of disabuse you of the notion that the Fed cutting interest rates immediately results in lower lending rates for the government, for home buyers and so forth. Typically, those rates are already falling into Fed rate cuts, and the rate cut follows that signal that fixed income or the bond market is discounting weakness in the economy. So we are in kind of a weird spot, and I can sympathize with their feelings about, what about this inflation? What about these tariffs? Now, if the market continues to hold up like it has, and I'll show you the charts in a second, the odds of the July 9th deadline delivering higher tariffs than what the market seems to be discounting, that could get pretty ugly in a hurry. So we'll wait and see. Playing some defense right here remains very, very smart in my view, to be honest with you. I think it's going to be interesting to watch and see it unfold. But I think clients, you all need to understand, the relationship between the Fed funds rate and market-based interest rates. I had friends, close to the mortgage business and the real estate business, begging for this back then. And I did a video back then. I said, be careful what you beg for, because right here, probably not a good idea. And sure enough, you can see what happened. Rates went up a bunch on that and the 2 subsequent rate cuts. So we'll see. Okay, so let's jump to markets. I have QQQ, the NASDAQ 100 index, dialed up here first. I was looking at the very short-term chart. This is a 15-minute chart, just to kind of gauge today's action. Now, this suggests that there could be weakness between now and the close, and you won't get this till well after the close, but we'll see. Not that we're trading or investing based on a 15-minute time horizon. When we look at the 1-year daily chart, which is important to us, folks, this is almost as bearish as the gold chart has been, as far as I'm concerned. Here we are peaking above these recent highs, right? Still coming out of a rising wedge pattern. I'll be redrawing a trend line here soon and peaking up above what is this resistance where it lost it here. So this would be a triple top if it falls apart. The momentum indicators say it's going to. This right here, longer-term trend followers who use moving averages would be getting very bullish right here. We have the golden cross. The 50-day is now, as of today, moved back above the 200-day. Those do not have the success rate, by the way, that these kind of patterns do in terms of dictating where the market's going in the near term. So this is not a technically good-looking pattern to me right here. Virtually the same pattern for the S&P 500. Not quite above these levels here just yet, but threatening them with pretty noticeable bearish divergences, and both are pretty close to being overbought. Here again, would make sense to me that there's some weakness coming in the next few weeks. Gold, remember, I kept saying over and over again this whole time that we're cautious, even bearish short-term on gold. I said the other day, it wouldn't surprise me to see it come all the way down and find support at the 200-day moving average. As of today, it's broken down below the uptrend and below the 50-day moving average, although it's fighting its way back towards it right here. You get a little space between here and the 50-day over the next few days, and you break below this short-term level of support here, and it could get pretty ugly for oil. What it would take, for gold, what would help this technical pattern obviously would be more good news out there, more news that the world is safer and we don't need to necessarily rush to gold. Gold for us is a long-term play on big U.S. deficits and in our view, very high odds of a weaker dollar and negative real interest rates over the next few years. And we've gotten into those weeds before, and I will again at some point. But when I put on my technician hat, gold does not look good to me in the very short term. We're definitely feeling it today, but we are hedging, right? Last time I looked, we were mitigating about a fourth of the decline today. Okay, the dollar, wow, tried to peak above this trend line. Geopolitical angst, suddenly the dollar was a safe haven currency. You can see it touched its 50-day moving average, which is sloping down. And here it is today, falling below the trend line here. The dollar remains weak on a short-term basis. Still wouldn't surprise me to see some strength, but it might take a stronger economy than people think. The economic surprise index, as I showed you over the weekend, is really low right now, meaning the economy has been worse than what economists had expected. And if that continues, the dollar probably continues to wane right here, which helps very much in traditional trading terms, the advantage that non-U.S. has over the U.S. in terms of, say, equities. Typically, it would favor commodities, although that's not happening today. And we shall see. There's a new kind of thesis that I'm sympathetic to that's building about the relationship between the dollar, the rest of the world, and other asset classes based on how things have changed here of late. And I'll definitely spend some time either writing on the video or both on that new thesis going forward and tell you what we think about it. Yields, interesting because it's been good news today, right? And here bonds are rallying and yields are going down. If you just looked at the bond market right now, you'd say, uh-oh, there's something troubling afoot. And maybe it's, some of that view of weaker economic data. Maybe our view that the economy is going to weaken is the right view. Time will tell. And there's lots of debate out there from really good qualified macro analysts who are on opposite sides of the view on the bond market going forward. One of my favorites, who's been spot on for a long time, thinks there's a massive bear market in bonds coming the second half of the year, and that would be much higher yields and much lower bond prices, and also that would be much lower stock prices as well. Don't know that I entirely sympathize with that. I can understand the argument, and we'll probably explore that more as we go. I already showed you this one, so I'll leave it there, folks. Thank you, as always, for watching and listening, and I'll be back at the end of the week. Have a good rest of your day. Bye-bye.